Yeah, I would like to welcome you to our lesson number 3 in our series of financial accounting. In our lesson number 1, we discuss about the accounting equation. In lesson number 2, we look at the application of the accounting equation in the balance sheet. Now we are moving at an advanced stages and get to familiarize with ourselves with the kind of books that are kept by an accountant. And in this case, I will focus on the books of original entry. Another term for such kind of books, they are called prime books. For you to be an accountant, you need to understand these books first, because record keeping is the key function of the accounting office. Now, what are books of original entry? We are saying is an accounting record that is used to record the different types of transaction in a chronological order or in a date order. That means transactions are recorded as they occur, not in arrears. The reason for being called books of original entry is that this is the first place that business transactions are formally recorded. You can call this, you can think of a journal as a financial diary. Specialized journals are used to initially record special types of transactions, such as sales and purchases. All these journals are designed to record special types of business transactions and post the total accumulated in these journals to the general ledger. Remember, as an accountant, you will end up preparing financial statements. Financial statements give a summary of several transactions, but the place you record your transaction as they happen before you transfer them to ledgers and other books. Those books which you record transaction initially, they are called books of original entry or prime books. Now, let's have a look at some of these prime books. And we are saying sales journal is one of the prime books. The sales journal is a special journal where credit sales to customers are recorded. Another name for this journal is the sales book or sales day book. Those terminologies means the same. Remember, when you sell credit, you sell goods on credit, you end up creating debtors. Yeah. Therefore, it is very important to make or to have good records of your sales which were made on credit. Sales that were made on cash, you'll have your cash receipts. Now, sales journal is one of the prime book that you record credit sales before you transfer these sales to individual customers' ledger. Then these sales are recorded in sales journal. The second one is the purchases journal. The purchases journal is a special journal where credit purchases from customers are recorded. Another name for this journal is purchases book or purchases day book. The three terms means the same. Here, you purchase goods on credit. You purchase goods on credit. These are liabilities. They are called accounts payable. Credit purchases, they bring in creditors. Therefore, you record these credit purchases in purchases journal. Return inwards journal. When we talk about returns inwards, these are sales returns. You made sales, then inwards means they are coming back. You made sales, maybe the goods were faulty, they had default, or they were not up to standards, the customer returned those sales back. Then we need to record the sales returns or return inwards. The return inwards journal is a special journal that is used to record the returns from debtors and our allowances of goods sold on credit. Another name for this journal is sales return book. Good. Now, so far we have looked at those three. We shall come into inner details about them. Then we have returns outwards journal. Return outwards refers to the purchases returns. You bought goods on credit, but you realized they were not of the quality and the standards you needed. You return them. Then you have return outwards journal. Therefore, the return outwards journal is a special journal that is used to record the returns to creditor and allowances of good purchase on credit. Another name for this journal is purchases return book. Now, in many organizations, especially companies, even schools and any other organization, you can never miss a cash book. A cash book are used to record receipts and payment of money by the business in the form of cash. Cash book. We shall soon see cash book of two types. In fact, there are 3 types. There is a 1-column cash book, there are 2 columns cash book, and there are 3-column cash books. We are going to look at and see that the 3-column cash book is a special cash book because it records the discount received and the discount allowed, which is not recorded in the other cash books. Therefore, we are saying that a cash book is used to record the receipts and payment. In most transactions, if you have made sales in cash, you issue receipts and transfer these receipts information to your cash book. Now, when you make payments, similarly, you transfer the information to a cash book. Therefore, a cash book is a prime book that is used to record receipts and payment. The petty cash book, this is just a fancy name that describes a special fund that is set up and used to monitor and unanticipated cash expenses, where a check can't be written or the amount is so small that you don't want to write a check. The petty cash account is based on IMPRES system, which is a system of cash disbursement, cash expenditure, reimbursement of that expenditure. Now, petty cash, these are expenses which recur daily in a business organization. Yeah, like purchase of snacks, routine maintenance, fare, transport of maybe fuel for maybe organization bus. You see, those expenses that keep on recurring, there must be enough cash or some cash to take care of those expenses, which do not necessarily have to bring inconveniences of going to the bank, withdrawing, writing a check, because they may even be immediate. Therefore, petty cash are recorded in a petty cash book. We shall look at the nature and the format of each and every prime book as we continue. And finally, we have the general journal. The journal is a textual record of events, debit and credit, that is characterized by the fact that all the records it contains are in sequential chronicle order. The general journal is used to record unusual or infrequent types of transactions. Types of entries normally made in the general journal include depreciation, correcting types, correcting entries, adjusting and closing ledgers. Now, we have mentioned the prime books above, but there are some transactions that occur but they cannot belong to those prime books that we have written there. A good case is depreciation. When an asset loses value, you don't have a journal to represent that. Basically, those transactions that don't fit in the above journals, you bring them to the general journal. That means they cut across in almost all other journals. All the information is important across several of the information that you've added into the respective journals. Therefore, you transfer them to general journal. Like this, let me give it. If you purchase or you buy water, you buy electricity, those are information that you cannot transfer them to other journals. You bring them to the general journal. Yeah. But general journal, basically, you need those transactions that they cannot actually fit in any other journal. A good case, if you want to make correction of some entries you made, you bring that information into the general journal. If you want to make some adjustments, maybe you made an error, you bring the information to the general journal. Good. Now, we want to look at recording transaction from the source document. These prime books, information will spread up to other ledgers. It's not the final destination of the information. You record the information in the prime books. You transfer this information later to their respective ledgers. If there were sales, maybe you made sales to Kamau. You record in the sales journal, you made sales to Kamau on credit. You go and open up a debtors by the name Kamau, and you debit Kamau with the amount you sold to him. Therefore, recording this transaction is key to a professional accountant. Journals use the information from the source document to create chronicle listing of all business transactions and detailed information about each transaction. Journals are primary records where business transaction first entered into the accounting system. The journal is commonly referred to as book of original entry. Specialized journals are journals used to initially record special type of transaction. This information we have already mentioned about it. Now, let's look at the sales journal or sales day book. We are saying that sales day books are used to record sales on credit. The sales day book record details of all credit sales by the business. The details are obtained from copy of sales invoices. And what are invoices? Invoices are documents or basically they are documents used to seek payment. When you offer a service on credit, you write an invoice to request payment. I've sold these goods to you, and this is the amount of money that you need to pay. Then you have issued an invoice. It is also called sales day book or records of the sales invoices issued by the firm during a particular financial period. So the format of a sales journal will look like this: date, details, folio, amount, and where you make debit and where you make credit in the sales journal is that debtors, you debit debtors and you credit sales account. Remember, sales account will have a credit balance and the debtors account will have a debit balance. Therefore, your sales journal will basically, when you want to transfer your sales journal to your ledgers, sales ledger, it will move to the credit side. When you have sold goods to the debtors, when you want to open up the debtors ledger, the value or the amount will go to the debit side. So how do we enter this information? you are to enter up the sales journal from the following details. March 1, credit sales to Omondi. March 3rd, credit sales to this. March 6th, credit sales to Charles. This information, they appear in a chronological order from March 1st to March 31st. And to enter the details, you only need to transfer those information to the sales journal. There's no much science behind here, is that the only value that you sold, you need to record it in this sales journal. Thereafter, you can extract this information to prepare Omondi account, and at the same time you prepare sales account. So when you're preparing this debtors account, we have said from this information that you debit debtors and you credit sales. You debit debtors and you credit sales. Therefore, this value here, when I open, for instance, if I open J. Njoroge account, I will debit J. Njoroge with 550 and credit sales with Njoroge of 550. We shall soon look at those ledgers as we progress. Now, purchases journal still all look alike. The sales journal, the format still the same. The only thing here I want to mention is when you purchase goods on credit, remember you have created creditors. So creditors, you are going to debit creditors and credit purchases. I think there's something wrong here, because when you purchase goods, those goods, they come to you. I'm sorry for that. This one is supposed to debit purchases and credit creditors, because purchases, they are goods that have come to you. Therefore, the purchases will be debited and creditors will be credited. So creditors have a credit balance and purchases have a debit balance. So I'm sorry for this mix up here, but hope you have understood. Now, do you have this information? Purchases on credit. So you're going to record this purchases journal details as they appear in each and every transaction. It's just as simple as this. There is no much science here. You only need to transfer the information from your receipts and create purchases journal. Sales returns or returns inward book. Now, when you return goods, return inwards. When you return goods, let me just go through this first. We are seeing that it is also called return inward book. It's record all the credit note raised by the firm and sent to customer during a particular period. You know, when you return goods, it means from your side, you had credited sales, you had credited sales, so you debit sale and you credit the customer. Therefore, the firm will inform the customer that we have credited his or her account with a certain amount of money because of the sales return. So the document that the customer will receive is called a credit note. A credit note is used to show that your account has been credited with this amount, and therefore less money you are to pay. You debit sales return and you credit debtors. And crediting debtors is the one you issue a credit note. A credit note will tell the customer that the amount you are supposed to pay has reduced. Purchases return, this one record or sometimes called return outwards book, record the purchases that were returned to the suppliers. When goods are returned, the creditor account is debited in order to decrease the liability to him, and purchases return is credited. So because the customer account is debited, you issue a debit note. You issue a debit note to the customer stating that you have debited his account with this amount, then it means he is supposed to pay less. You are supposed to pay less because you have purchased good and you have returned some goods. So that is how return inwards will look like. Let's look at an illustration here. You are to enter the following items in the books of 2011. Credit purchases from K. Amos, this one. These are credit purchases. They will move to credit purchases, they will move to purchases, the book. Credit sales will go to sales journal. Credit purchases will go to purchases journal. Credit sales will go to sales journal. Return outwards will go to return outwards journal. Return inwards will go to return inwards journal. Credit sales will go to credit sales journal. Go to sales journal. Credit purchase is the same. So basically, what you're supposed to do here, you need to work on each item at a time. Like in these credit purchases, I'm supposed to open up the purchases journal. Look at this. This is the sales journal. All items that relate to sales journal, meaning that I will come. The first item here was EKEN 11, S11, and the amount was 510. Then Rose was 246. You can see this is the first amount, and the ton was 356. You only need to record the amounts as they appear in the receipts. Now, the amount as they occur, you need to transfer them. Purchases journal, the same thing. You see, according to K. Amos, the first purchaser, that means credit purchases by K. Amos were 380, Ocheng 500, Oloch 106. If you come to the purchases journal, you're going to notice that let me go to purchases journal. I've moved very fast. Let me go to my, yes, let me go to where I'm supposed to be. Good, I was saying that when you open up the sales journal, you open the purchases journal, you'll end up open return inwards journal, and finally, you open up returns outward journal. So when you want to record this journal, journals, there is no big task. Yeah? You only need to record the date and description here. You need to, all details you need to give who was the debtors or the creditor. Yeah, and in this case, you record them and the amount that each and every transaction relates to. Good. I'm done with the journals, sales journals. Now I want to go to cash book. Now, as I mentioned before, cash book is a prime book that is available in almost 99.9% of the organizations. Yeah. Cash book will depend with the nature of the organization. There are those organizations that deal with a 2-column cash book. There are those organizations that deal with a 3-column cash book. Now, a cash book is meant to record all cash transactions. Whatever is in their nature, it is divided into 2 sides. One, the left-hand side for receipts of cash, and the other one, the right-hand side for the payment. Since in a modern business, transaction with or through bank are even more numerous than strictly cash transaction, each side has 2 columns. One to record cash transaction and the other one to record bank transaction. Payments into the bank being entered in the left-hand side and that for the cash being entered in the right-hand side. The left-hand side is known as debit side and the other side is called a credit side. Therefore, when you want to make one type of cash book will just be a ledger. So this one is not total. So 2-column cash book will look like this. 2-column cash book, a cash book at the bank, the cash at the bank cash book and cash in hand cash book are combined together to get 2-column cash book. That means in this side you shall have receipts and this side you shall have payment. Immediately you get money, when you get receipt, you record the date the details of that receipt and whether it was received in cash or bank. When you make payment, you record the date, the details of that transaction, and whether you made payment in cash or bank. So look at this. Write up a 2-column cash book from the following details and balance of as of the end of the month. So started a business with a capital cash 1,000. That means this one will go to the receipt, the debit side. Yeah, I'll go to the receipt. Paid rent by cash, you go to the credit side of payment. If Atieno lent as 5,000 paid by check, you let 5,000 and this one was paid by check. That means you go to the credit side. We paid Biomolo by check 650. Credit payment. By check, you go to the bank. Cash sales of 980, these are sales. You debit them into the cash book. And Mwangi paid us by check. This is cash book debit side, but go to the bank. We paid B Musau in cash 220. The payment is on the credit side, but the amount is 220 and it's cash. Cash sales paid direct into the bank. This is contra entry. It is a sales in cash and then you make payment direct to the bank. That means what is happening here? You make sales in cash and then you remove that cash, you take it to the bank. That means that the bank will be debited with cash, and in the debit side, we shall have contra entry. We shall have bank increasing by 650, but it was from cash book, or it was from cash. And then on the credit side, we shall have cash decreasing by 650 going to the bank. We took shillings 500 out of the cash till and paid it to the bank account. This money was removed from the cash and taken to the bank, contra entry again. We paid F Atieno shillings 1,000 by check payment. Cash sales paid direct into the bank, shillings 660. That is contra entry. Cash then was made to the bank. Paid motor expenses by check of 120. Withdrew 1,000 from cash from the bank for business use. That means the money was withdrawn from bank, from cash. We drew 1,000 cash from bank. That means the bank will reduce by 1,000 and cash will increase by 1,000. That means you credit bank with cash and debit cash with bank. Paid wages in cash, those are payments. So the cash book will just look like this. The cash book will just look like this. Capital you debited. There are those the scenarios I was mentioning about contra entry. Contra entry, you label them with C. That means you remove some cash. You see, you see in the payment side, money was taken away from cash and debited to bank. That means the bank increased by 500 and the cash reduced by 500, and this is what we're calling the contra entry. Also the same here, the cash reduced by 1,000 from bank, and then the bank increases the cash by 1,000. So these are the transactions as they appeared in the illustration above. Now, for a 3-column cash book, it is similar to a 2-column cash book. The only difference here is there is discount allowed and discount received. I think with this information here, what I want you to note, I don't want to make it tiresome for you. So for today, I want to stop at 2-column cash book, and the next lesson, we shall pick up from 3-column cash book. Therefore, in simple terms, we are saying that a cash book will have both receipts and payments, and receipts are on the debit side, payments are on the credit side. If money is coming to the business, you record them on the debit side. If money is going to the business, is getting out of the business, you record them on the credit side. And if money is not getting out of the business, is only changing the position, like if it is the money in cash being taken to bank, that means the amount of money in cash will be credited because you are taking money from cash and then you deposit that money into bank. It is called a contra entry. That means money getting out of cash and then going to bank. Similarly, when you have money getting out of bank, you debit bank, this money going to cash. You have money in the bank, you remove money or you withdraw money from bank and you have it in cash. It's also a contra entry. Basically, that is the end of our lesson 3. I look forward to continue from 3-column cash book during our next lesson. Otherwise, I appreciate your time. Thanks for watching. Kindly subscribe, share the video, and request your friends to join and make this learning comfortable and enjoyable to all of us. Otherwise, thank you. Let's meet the next lesson. I look forward to meeting you, and welcome. Subscribe there, comment down there, and let me know if there's a specific issue you'd like me to help. I will be ready to do so. Otherwise, thank you.